Hey everybody, it's Mike from Orderflows and welcome to today's video. Today is October 13th, 2022, and the CPI number came out today. Came in hotter than expected. It rose 0.4%, which is basically double market expectations. Year on year, we're still high at 8.2. And the core CPI at 6.6 is the most it's been since 1982. And the market did what it's supposed to do. It got slammed. However, afterwards, the market rallied. And let's take a look at what happened at the numbers. So this is this is the mini chart yesterday, and we're just sort of humming along, and then bam, the number comes out. We drop basically over 100 points. And what was interesting in this drop is obviously there's no liquidity initially, right? It took a long time for the market to find some liquidity. Basically, I mean, when you look at it, from 36.13 and 3/4 all the way down to 35.73 1/4, there was no trades, nothing. All the liquidity got pulled. The CPI number is probably, I don't know, we could argue back and forth about the non-farm payroll and the CPI number, but it's the number that traders are really watching very closely to see what's happening, with the economy. And it's one of those numbers that you don't want to be participating in. I saw some people posting some charts and stuff. Oh yeah, they're talking about what's happening right before the number gets released, what position they would take. No, professional traders, that's why there's no liquidity here. The professional money is out. All right? They're not sitting here trying to play the number unless they got some sort of inside information, or some of these hedge funds hire people from the government that used to work on these numbers to sort of construct the number themselves. But this lack of liquidity here is very glaring and very telling. That's a 40-point area where there was no liquidity. Finally, it hit some resting bids in here that have been in here for a while at 72 3/4, 69, on down to 57. And I even saw a post of a person who says, well, yeah, the market dropped because it happened in the pre-market. Yeah, the market dropped not because it was in the pre-market, because his argument was there's lack of liquidity. Well, yeah, because people aren't participating in it. Everyone's waiting for this number, right? All eyes around the U.S., the professional trading desks, the banks, the hedge funds, they're waiting for this number to come out. And the way this market's been recently, the last several months, this is like, I'll say the World Series, or the Super Bowl numbers, but it's highly anticipated, I guess is the term that I'm looking for. And it didn't disappoint in terms of market reaction, right? I mean, we had over 100-point drop within a couple of minutes. We got down 35.10 right here in 1/4, and then we bounced up. Now, I've always told people, everyone, they're all excited about trading the numbers. No, you don't want to be involved around a number, because if you get it wrong, you're going to get bent over and something stuck up your body you probably don't want. So let the number play out, right? I know for many traders, they let the number come out, let the market digest it. All the retail money, everybody that's stopped out of the market, etc. Once they're all stopped out, the market's going to find some sort of balance again. And usually 5 minutes, 15 minutes is enough time, because you can see how this market is reacting. Okay, you're getting bars. Basically we'll call this one 35.12 all the way up to 35 31. So almost a 20-point bar in. This is a 30-second chart. It's not a 1-minute chart. It's not a 5-minute chart. It's a 30-second chart. You have to understand that when you have these big numbers coming out, there will be volatility. It's not like looking at it after the fact, oh yeah, there was a lot of volatility in the market. No, when you have a big announcement, a big number coming out, CPI, non-farm payrolls, obviously a Fed announcement, there will be volatility that ensues. I mean, you don't have to guess, is there or isn't. You have to expect it. You have to expect that there's going to be volatility, and you're going to have these wide-ranging bars. Let the market settle down. It took about 5 minutes to sort of settle down, actually more like 10 minutes, where you're sort of getting back to sort of normal 3-4 point bars. And the best advice I give is just wait till the cash opened at 8:30 if you're going to start trading. And once the cash opened today, we came in, we started selling off, we put in this new low at 02. Okay, we have a divergence. We got some positive deltas coming in down there. You know, delta divergence being a new or equal low with positive delta. And the market rallied from 02 basically up to 20. Then it just sort of, you know, we had a level up in here from earlier acting as resistance. After it popped up, some aggressive selling came back in. We sort of went back sideways from 35.808 up to 13.14. But in this area where we're going sideways, there was a lot of bullish order flow coming in. You can see here, you know, we got multiple buying imbalances in the one bar. We got a very strong delta, 1600, and it's closing sort of on its max delta number. Our delta number was 1617. Our max delta was 1618, so we're closing right on it, basically, which is a sign of very strong aggressive buying. Now, that doesn't mean that there was no aggressive selling in the bar. What max delta means is how strong the positive delta was in the bar, okay? And we got, you know, these two blue bars. This is our you know, very bullish value areas coming in here. So as this market is sort of going sideways, we're seeing value being formed, right? Because we found a balance area, and when you're in balance, right, you're forming value, and based off of what you're seeing in the value, it's becoming bullish in here. Like these two blue bars is bullish value areas. Obviously, the aggressive buying in this bar, we do pop up to sort of this new swing high up to you know, 23, come off again, and then we start seeing that aggressive buying step right back in. You're seeing a stack buying imbalance here, a stack buying imbalance here. Obviously, another bullish value being formed right here. We have a inverse imbalance. So what do we have happening here? Okay, we're, you know, our low is 02. We're trading around, you know, 14, 15 in here, you know, all the way up into 20, but we're seeing very strong buying coming in. All right, we're seeing stacked buying imbalance in this bar, followed by another bar with stacked buying imbalance, followed by another bar with an inverse imbalance, which is a sign of trap traders and absorption taking place. And sort of to open this bar up a little bit more, I've talked about this before. What do we have at the top of this bar? Right, well, the point of control is up near the top, but more importantly, sort of our heaviest volume is taking place here, the 474. All right, 474 is your biggest volume in this bar, right, at 14 3/4. It's the biggest volume in the previous bar, in the previous bar, in the previous bar. So what happened? The market sold off. Now we're getting the aggressive buyers coming in. Now we're getting not only the aggressive buyers coming in to take the market higher, but now we have a strong passive buyer to absorb whatever selling is coming in here. So they're absorbing, you know, you can see it's the imbalance, 474 against 16. We got, you know, 309 against 259. Now that's not an imbalance, but again, 309 is a heavy volume as well. And then in the next bar, more aggressive buying comes in just above those levels, and we're starting to go higher, right? That's what you want to see, right? You don't want to just see aggressive buying taking place. You want to see, after that aggressive buying, what you want to see is the market go bid over. You want to see it get bid at that price level to indicate that, yeah, not only do we have aggressive buying taking the market up, but we have strong passive buying supporting the market from dropping further. And the market starts marching up. It was a very dramatic, quick rise. You know, there really wasn't much bearish information in here, you know, coming in. You know, even this bar, people say we got this big negative delta, minus 677. Yeah, that's a big, strong negative delta, but the bar's a green candle. Look at why it's negative 677 is because look at this volume. This big bid came in here, you know, traded 1038 here on the bid. It's 1,000 on the bid here at 31 1/4 to support this market, right? Just as we saw earlier here, this 474 is supporting this market. Okay, and you see the market, you know, you can just draw these lines in here, right? Just draw the F6 here. Okay, I know that around the 31 1/4, there's support, right? It does dip back into it in the next bar and a couple bars later, but it's not really breaking down. Okay, so I know, you know, when I see that big volume just stick out like that, it's so obvious that there's support in this market, the trade you want to be taking is to the upside, right? And then it pops, boom, big wide bar, big big volatility, 33 low up to 43 high, a 10-point bar. Again, this is a 30-second chart, right? It's not a 5-minute chart. You're getting 10-point bars really quick. So again, from the 31 and a quarter area, trades all the way up into the 40s, right, within 2 or 3 minutes. Okay, the market sort of pulled back. Again, this 31 area, right, where you had that big volume. What do you think? Well, that's probably going to be a support area, right? Because I know I had big buyers down in here. When it comes back here, you want to be asking, are they still there? Is the support being held? And, we get within a point of it, 32 and a quarter, and then we sort of rally back up again quite strongly. Bullish value area being formed here as this market was going sideways. Rally up, more aggressive buying taking place here. You got 1, 2, 3, 4 buying imbalances. That's why there's this green bar around here, out of nowhere, right? We're just sort of putting in your, it looks like we're just sort of rotating here. This is your first sign of aggressive buying. This is what our software will do, is it'll highlight these bars where you have those spread out buying imbalances, right? Then the next bar's got the stacked buying imbalance. People ask me, which is more important, stacked buying imbalance or multiple imbalances? Well, in my opinion, multiple imbalances is probably a little bit stronger than stacked buying imbalances, simply because it can come in before the stacked buying imbalance. If you're waiting for a stacked buying imbalance to come in, it comes in here around 44. But if you're watching this bar before the stacked buying imbalance, you're seeing those multiple buying imbalances come in, right? And then again, we pop all the way back up into the 60s where we hit a level from earlier at 56. We do bounce back down to where? The area where you had the aggressive buying taking place, right? Where that stacked buying imbalance was, and the market just bounces back up. And this is all just, this is at 9 in the morning already. We've only been open since the cash for about 45 minutes. This is what, 9:10. Here's 9:15. So this would be about 45 minutes, and already you're getting a lot of action. People talk about volatility. You have to expect those days when there's going to be a lot of volatility in the market. And like I said, when you have a big number coming out that everyone's watching, CPI is one of them, non-farm payrolls, you're going to expect volatility. You're going to expect that if you're trading, by the end of the day, you're going to feel like you've been, in a wrestling match. Basically, you're going to feel exhausted. And to be honest, the way this market was moving, is very reminiscent of, I don't want to say 2020, when COVID hit, but more reminiscent of the financial crisis, where you get these big pushes down and big pushes back up, big swings, and it's just sort of coming in waves and waves, one after the other. Anyway, we pull back again. You had the bearish value area coming in here, but then we just went sideways. It didn't really sell off. Okay, so when you get something that's, the market is starting to sell off, you get something bearish, you get the bearish value here, and then the market just goes sideways. If it's not breaking, what do? You don't sit here and get short and wait and sit and hope. Well, you got the bearish information in this bar. Next bar is inside, 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 right? When you have bars that are inside for an extended period of time, and in this case, it's 1, 2, 3, 4, 5, 6 bars, which is quite a lot. Anything over 3 is inside bars is a lot. Wait for the breakout, and it comes right as you're breaking out here. You got to stack buying imbalance. Okay, what's that telling you? The trade is to the upside, right? And you see it moves, but again, from 47 just up into the 53. So it's not one of these 10-point moves, but you have that breakout coming in right here. Now I do know that I had this area here, 44, we'll call it 45 right here, just outside that, down to 43.5. That if the market comes back down, okay, sort of that's an area that I'd be looking for the aggressive buying to come in. And it didn't really come. It came in there, and even though it's breaking through, it's kind of holding. If you're long off of this stack buying imbalance, you're running into some bearish information here, and obviously you got the stack buying imbalance here, but it's followed with another stack selling imbalance right afterwards, which is a bearish sign. If you're getting short, you'd be looking for some support in here, and it just sort of goes sideways. You can see these point of controls just lining up one after the other. Finally, it looks like it's going to break. And then it just has, a volatile market does. Just as it looks like it's breaking down, it reverses back up. All right. Now, again, what was interesting is, which is something you see a lot on volatile markets, are the back and forth imbalances, right? You got two stacked buying imbalances followed by a bar with stacked selling imbalance followed by a bar with stacked buying imbalance, right? And it's frustrating, let's say the least, when you're seeing that. And again, these aren't big imbalances per se. The volume's involved. It's 7 against 41, 0 against 10, 7 against 36. Here's 0 against 18, 0 against 14, 0 against 39. So it's not like, something against 180 or 140 or 390. It's kind of thin volumes, but that's to be expected on a market that's exhibiting some volatility. Now, in the next video, I'll talk a bit more about what this level is here. This is what we call market weakness. There was, again, this was market weakness taking place here. But again, it's interesting because this market, right, if you are using the Orderflows Trader software, you got a bullish prominent point of control here. Here you've got bullish value area forming, right before the market pops back up, basically from 60 almost up to 70, got up to like 68, but it was a nice move up here. Just trading these value areas, right? These bullish and bearish value areas. Here's a bearish one. Obviously you got that stack selling imbalance coming inside there, and just look how the market sells off, comes right back up to that stack selling imbalance where you had the aggressive trading taking place, and starts coming off a little bit before you get the aggressive buying coming in. But again, on a market that has volatility, it doesn't take much to cause a stacked imbalance. Okay, and that's why you're going to see more on days that are more volatile. Just as, on markets that exhibit more volatility, like say mini NASDAQ, MNQ, or even NQ, you're going to see these a lot more imbalances than you would as opposed to seeing it in the E-minis. Okay, this purple line, in case you're wondering, that's market strength taking place there. But again, I'll talk about market strength, market weakness in a different video. But really what I want to cover today is just, the crazy price action. I mean, you can see, right, it even went all the way up to 75, came back down, back up again. I mean, it was just a real roller coaster of events. And, honestly, I could talk about the rest of the day, but this video would probably go on for about 2 hours. There's just a lot of information. But, really what I want to talk about, as I did, was, what to look for on days where you're expecting high volatility in the markets. Okay, and again, it's not one of these things where you look after the fact and say, oh, yeah, that market had high volatility. No, you got to know, right? Part of being a trader is understanding days that can exhibit high volatility. Now, I wasn't expecting this market to have such a violent swing down, followed by an even stronger swing back up like we had today, 2% down, 5% up, but, from the lows. But it's just one of those things where you have to come in being ready, right? Have sort of a plan of action, say, yeah, you know what, today is going to be a volatile day, and I'm going to have to be quick in my analysis. I'm going to have to be quick in my pulling the trigger on the trades, basically, right? Because what you don't want to be doing is caught, lollygagging, eating a popsicle or ice cream cone while the market's going nuts. Okay, so if you enjoyed this video, I'll end it there. If you enjoyed this video, be sure to like, subscribe. It makes me feel good that people are liking the videos and subscribing to the channel. That's why I put out this content for you. So thanks, everyone, and I'll see you guys on the next video.